In the complex interplay of factors that influence financial decision-making, the psychological aspect stands out as particularly significant. Behavioral finance, a field at the intersection of psychology and economics, examines this facet by exploring how individual behavior and cognitive processes affect financial markets and decision-making. This video delves into the core principles of behavioral finance, highlighting the role of mindset, and elucidates how these elements shape financial outcomes. The basics of behavioral finance. Behavioral finance challenges traditional financial theories, which often assume rational and optimal decision-making by investors. Instead, it posits that investors are not always rational, are influenced by their biases, and make decisions that deviate from those predicted by classical economic theories. Key concepts in behavioral finance. Heuristics. These are mental shortcuts or rules of thumb that simplify decision-making. While they can be helpful, they often lead to systematic biases. Prospect theory. Developed by Daniel Kahneman and Amos Tversky, this theory suggests that people value gains and losses differently, leading to decisions that deviate from standard economic predictions. Loss aversion, a core component, describes how losses are felt more acutely than gains. Market sentiments. Emotions like fear and greed can profoundly affect investor decisions and market outcomes. The influence of mindset. The mindset of an investor can significantly impact their financial decisions and, by extension, their financial health. Carol Dweck's work on fixed versus growth mindsets provides a valuable framework for understanding these effects. Fixed versus growth mindset. Fixed mindset. Individuals believe their abilities, intelligence, and talents are fixed traits. They are less likely to take on challenges and learn from failures, which can hinder effective investment decision-making. Growth mindset. Individuals believe that their skills and intelligence can be developed through hard work, good strategies, and input from others. They are more likely to embrace challenges, persevere through difficulties, learn from feedback, and achieve higher levels of success. Application to finance. Applying a growth mindset to financial decision-making encourages continuous learning and the adaptation of strategies in response to market changes and personal financial goals. It makes an investor resilient against setbacks and more open to exploring new investment opportunities. Behavioral biases in financial decisions. Behavioral finance identifies several biases that typically affect financial decisions. Overconfidence. Believing one knows more than they actually do can lead to risky financial behaviors. Confirmation bias. Seeking information that confirms one's preconceptions may lead to ignoring contradictory information. Anchoring. Relying too heavily on an initial piece of information to make subsequent judgments can skew financial decisions. Herd behavior. Following the crowd can lead to irrational financial decisions, particularly in volatile markets. Implications and strategies for investors. Recognizing and mitigating these biases and maintaining a growth-oriented mindset can greatly enhance decision-making processes. Strategies for investors include diversification, spreading investments to reduce risk. Continuous education, staying informed about financial instruments, market conditions, and economic factors. Emotional regulation, developing techniques to manage emotional responses to market fluctuations. Seeking professional advice, consulting financial advisors to obtain an objective perspective. Conclusion. Behavioral finance offers profound insights into how human psychology impacts financial markets and individual financial decisions. Investors can make more informed, rational, and successful investment choices by understanding and adjusting for these psychological influences, particularly through cultivating a growth mindset. The exploration of behavioral finance continues to reveal that finance isn't just about numbers. It's equally about how we think and feel about those numbers. Thanks for watching. Don't forget to subscribe to the channel for your success. If you like this video, please give it a thumbs up.